Research and Education in Axiory, and this is our webinar, Halloween webinar, second Halloween webinar from 25th of October. And this is a recording of this webinar because when it was live, we had a lot of questions. We had a discussion with traders. So this webinar lasted more than 1 hour. But we want to make it easier for you to learn to get this essence from it, the most important information. That is why we are recording this webinar again for you. So this is a recording without participants. On the original webinar, we had a lot of traders, a lot of clients. Everybody was really happy. You left great comments after this review, so thank you very much for this. Obviously, for some of you, this knowledge was new, so it would be nice to review it with this video. Well, that's how we're supposed to learn. That's how it should look like. Education process. You learn something new, and then you review it again, right? To let that knowledge sink in your brain, and that's a clever, that's a good thing to do. I did the same when I was learning. For example, now I'm learning languages, Portuguese, Spanish, etc. So you learn something new, and then you need to review it, learn this again week after, 2 weeks after, because it's not happening like this, that you will learn something one day and then you will remember it forever. No, you need to learn it again. So the same is with Forex trading. Okay, guys, without further ado, I explained you why this recording is a bit different than the original webinar. So without further ado, we can proceed to the webinar. Obviously, introduction for those who didn't watch the first seminar, for example, or skip this part in the first seminar. Let me introduce myself first. So my name is Tomasz Wiśniewski. I'm a head of research and education in Axiory. I'm also a professional trader. I prefer to trade price action, swing trading. Price action is trading based only on the price movements without any indicators, without fundamental analysis, and swing trading is just the horizon. So I'm looking for trades from, let's say, 1 hour to a few days, 2 weeks maximum. So this is my trading horizon. I have 10 years of experience in trading. I started on stock exchange. I started with shares, futures, and then I moved to forex market to trade on the currencies, commodities, CFD for various of instruments, as you know from yesterday's webinar. Throughout my career, I did, I have 10 years of experience. Throughout this time, I did hundreds and hundreds of webinars and seminars, as you can see, across the globe, from Far East to Far West. I visited many countries teaching traders. I spoke with really thousands of traders, so I know exactly what you want. I know the level of knowledge of most of the people. I know the learning process, how it looks like. So with me, you are quite safe. I would like to say this. I'm media expert, so I'm asked to explain situations on the different instruments, from oil to local currencies, etc. I was in Bloomberg. I was in local news in Poland, Malaysia, Nigeria, Philippines, and few TV stations. So I have this experience in this matter, and also I am an academic guest lecturer on the Koźmiński University, which is the best private university in Poland, where I was teaching how to forecast exchange rates of the currencies, of the currency pairs. So precisely what we are doing here right now. All right, so first the webinar was about basics, like what the Forex market is, who the market participants are, what do you trade, when do you trade, etc., etc. Basics, basics, basics. And I told you that on the second webinar, we'll learn something more important, more significant, something more interesting. And here we are. I'm going to show you some patterns, some technical aspects of trading, which will help you to trade. Basically, even based on one technical formation, you can start trading. You can look for this formation all over the place on many instruments. You can eventually find this formation and trade this formation. So trading is this simple, guys. Again, that's the thing. Trading is simple, but it's not easy because applying those simple principles is not easy. That's the thing with trading. So trading is simple. Why trading is simple? What is trading all about? Is about buying low, selling high. But the thing is that on the Forex market, you can go both ways. So you can as easily buy as sell. So you can also sell high and buy low, which is an excellent opportunity and generally a situation for the recession. So when there is a recession, people are losing money. Most of the people are losing money on the stock exchange, but on the Forex market, no, because on Forex market, recession is an opportunity because you can as easily sell as buy. So let me show you this. This is an example of an uptrend, but also this is an example of the price movements. This is how the price are moving on the market. So it's not like the price goes up straight away or down straight away. No, you have a time of a downtrend, you have a time of a sideways trend, then uptrends, correction, uptrend, correction. So this is how price moves. And price action, so my approach to trading allows you to find those patterns ahead of time. So I will know that that is a correction not here when the correction will end, but I will know it here, that I will be able to enter this. I will know that is an uptrend. I will know here, not here. All right. So I will know before in order to make profit from it. So the aim of trading generally is buying here, buying here, buying here, selling here, here, here in order to make profits. That's in an uptrend. In the downtrend, you are aiming for selling here, and for example, buying here, right? This is how it works. So you sell here, you buy here. That's an uptrend and that's a downtrend, but also you have range trading, so you have sideways trends. So you have times when the price is going without any particular order, is moving sideways, so more or less the price stays the same. And to draw a line, you need 2 points, 1, 2, and then you can draw a line. So you draw a line, 1, 2, a line. In range trading, the price is moving from a resistance to a support. Support generally is a place where traders find this price attractive and they start buying. And the resistance is generally the place where traders find this price not attractive and they don't want to buy anymore and they start selling. In a nutshell, there are many more. You can explain support and resistance in many more ways. Okay, many different ways. This is mine. Okay, so support is a place where more people want to buy instead of selling, and the price goes up. Obviously, support can be broken. Boom, the price goes down, and here many more people want to sell. Fair enough. That happens very often. But in general, resistance is a historical place where traders preferred to sell than buy, and support is a historical place. It's based on the history. So this point is based on the history of those, where the traders wanted to buy instead of selling. They found this price attractive, and here they found this price not attractive. So how does it look like in the sideways trend? In the sideways trend, you have, I'm sorry, erase, clear all. Yeah, so in the sideways trend, you have 2 points, here, as a resistance, 2 points as a support, line, you extend this line, you extend this line. The price goes down, meets a support, you buy. The price goes up, meets a resistance, you sell. Price goes down, meets a support, you buy. Obviously, this trend does not last forever. Eventually, the price will move either one way or another. And here is an example. First of all, uptrend, then the sideways trend, uptrend again, downtrend. So let me show you this. Contact, line. You extend this line. Contact, you extend this line. Sell, buy, sell. Beautiful. Profit. You see? It is simple. Not easy though. It requires patience, education, knowledge, proper trader's mind, but the principle in general is pretty simple. Channel trading. In the sideways trend, you had channel moving sideways. In channel trading, you have channels moving up or down. This is channel up. Principle is the same. 2 points, give you a line. Extend this. 2 points, give you a line. Extend this. On the resistance, you sell. On the support, you buy. One hint for you guys. In an uptrend, in the channel up trading, it is better to buy. Sell occasionally. It is more risky. Why? Because in an uptrend, more traders are making money. They are profiting from this. They are making money. Those are losing. Those are just corrections. You want to go with the trend, not with a correction of a trend. So example here, sell, buy. Let me show you in practice. One line, 1 point, second point. Here is this. Sell. 1 point, second point, line. Buy. Buy, loss. But you had profit here, profit here, and one loss. I think that you can take this loss if you have so many profits on the way. And channel down formation, point, sell, point, buy. Okay, buy profit, sell profit. Very nice trade. Okay, in general, price is forming certain formations. Why we know this? Because smart people were studying this for a long time. They were studying price movements for hundreds of years, and they found out that price is moving in a certain way. Why? Because the price movements are driven by human emotions, human actions, and in terms of trading, in terms of investing, human emotions do not change. We are the same. We feel the same amount of greed and fear and all the other emotions associated with trading, and it does not change. As we have the same emotions, we make the same decisions. So the price is in phases, let's say, in stages of an uptrend, downtrend, correction. We have cycles, economic cycles, etc. It goes on and on, right? It does not change. We have recessions, we have prosperity, development, etc., bull market, bear market. It does not change. principles stay the same. And those smart guys study the price movements and they notice that price behaves in a certain way in certain occasions, forming certain formations. And those formations can be studied, those formations were labeled, named, and can be found now on the charts. One of those formations is head and shoulder formation. Left shoulder, head, and the right shoulder. Why it works? It works because it shows you the basic principle of trading. And what is the basic principle of trend following? I'm sorry. And what is the basic principle of this? Is that the price is in an uptrend as long as the price is making higher highs and higher lows. The price is in a downtrend as long as the price is making lower lows and lower highs. So look at this. Price is making higher highs and higher lows, higher high, higher low, lower high, lower low. Left shoulder, head, and right shoulder. Okay, so it shows us that the price stopped making higher highs and higher lows, started making lower lows and lower highs. So it's a signal to abandon long position and open short position. Beautiful. Let's see how it works in practice. Upswing, left shoulder, head, right shoulder, downswing. Very often, broken neckline, which was a support, is tested as a resistance, and boom, reversal. Another one, sideways trend, the price tried to attack new highs. Left shoulder, head, right shoulder, breakout of the neckline, drop. Inverse head and shoulder, price going, so we have this option for the opposite direction, right? Price making lower lows and lower highs, and then the price stops making lower low, starts to make higher low and higher high. There's a neckline, breakout of the neckline, upswing. Yes. Look at this. Downswing, head and shoulder, left shoulder, head, the right shoulder, upswing. I traded this. I bought here. Then I switched because the price made head and shoulder on the resistance, which was a signal for me to sell. And as you can see, I'm not showing you examples from the book because it will be easy. Everybody can read a book and post an example from a book. I'm showing you examples from a real life with real transaction. As you can see, sell here. It's from my account. It was from 25th of October. Now the price is somewhere here, so I have even more profit based on this head and shoulder formation which I showed you before 2 slides ago. Right? You have this in action. That was just the head and shoulder. I didn't trade using any more techniques here, any more factors. Just the fact that I had a head and shoulder bouncing from the horizontal resistance. It works. Downswing, left shoulder, head, right shoulder, upswing. Okay, simple as this. Another formation is a triangle. And on the head and shoulder, I show that if there is a head and shoulder, the price should go down. If there is inverse head and shoulder, the price should go up. But here I have a question mark. So you may think like, why this formation is useful if it does not show me if the price will go up or down? Well, it will, but you have to wait for the breakout because it can result with a bullish or bearish breakout. Where in the case that in the event that the price would break the lower line of the triangle, you would have a sell signal. In the event that the price would break the upper line, you have a buy signal. Simple as this. So it's a sideways trend, range trading, where you wait for the breakout. Once the breakout happens, you trade. Patience is the key, and symmetric triangles can give you a trend reversal or trend continuation. In this case, you can see the downtrend. There is the symmetric triangle, breakout of the lower line, and the downtrend. So you can see the trend continuation. And here you can see the trend reversal, uptrend, symmetric triangle, and eventual breakout to the downside. It can go both ways, but all you do is to wait for the breakout from the triangle. Another one is ascending triangle formation. Ascending triangle formation are very powerful patterns. So what do you have here is a horizontal resistance, which very often is a psychological level of, let's say, 70 or 1 or 1.1 or something. Depends from the instrument. Price meets this resistance once, but the buying pressure is rising, so meets this another time, second time, but the buying pressure rises, third time, fourth time, but the buying pressure is so strong that the price breaks it and boom, there is a huge upswing. This is very common. It happens with ascending triangles very often. Obviously, you have formation in the other way, which is a descending triangle. So the price goes down, meets a horizontal support, and there is a bounce. Meets again bounce, again bounce, again bounce, but the pressure rises and boom, breakout. Usually, when you have a breakout from the ascending or descending triangle, the movements are strong. Why? Pure psychology in pure market mechanics. Many of those traders who bought here, bought here, bought here, let's say 70, they said, okay, I'm keeping my trade on the loss as long as we are above 70, because they bought for 85, for example. 70 is for me a strong support. Once it will be broken, we will go to 69, I'm out of the position. So they have selling order here. The price goes down, breaks the support, and you have a lot of selling orders here because all those guys who had a bad position, wrong position, they want to escape from it. So bears meet more selling orders, which accelerates the movement. And this is pure market mechanics. No science, no magic, just the amount of orders, buy and sell orders. And now candles. Okay, those formations are pretty clear, I hope. And there are much more formations, but we describe the principle here. So, for example, we have also pennant. Pennant is like a triangle, but it's smaller and it's usually a trend continuation pattern, right? You have wedges. Wedges are kind of pennants and kind of triangles. There are two lines which are not parallel to each other, like in a flag, but they are pointing against the trend, right? About the flag, you have also flags, as we said. Flags are like channels. So you have a downtrend, flag, two parallel lines to each other, breakout of the downtrend line, and the drop. But flags are in smaller time frames as well. So we can see that this principle, general principle, is pretty easy. About candles, you need to know that they were born in Japan a few centuries ago. They traded rice. Then they started to trade rice contracts, which were first forms of future contracts that we know now. And one of the best traders back then was Mr. called Munehisa Homina, who was a top legend Japanese trader. And he, one of the first, understood the importance of the human psychology. He understood the correlation between demand and support. And thanks to this, he was unbeaten. He was the best trader and he developed Japanese candles. Later, it were used all over the place in Japan by every single trader. Western world, Europe, Americas didn't want to learn this technique. It was perceived as hard to learn, impossible to learn, very complicated, until a gentleman called Steve Neeson went to Japan, studied this technique, and after this he wrote a book. Book is called Japanese Candles and Other Japanese Trading Techniques, something like this. It's a candlestick Bible. If you're interested in candles, you need to read this book. All we know about candles is from this book. I never been to Japan. I want to go, but my knowledge about candles, obviously now it comes from experience, but first it came from this book. What are candles? This is another way to show you the price movements over time. So the chart, we know the line chart, right? This is the time, this is the price. We all know this. But on the line chart you have only one price. Let's say this is daily chart. So you will get the last price of the day connected by lines. Yes, those last prices of the day are connected by lines, but it's the last price of the day. Candlestick chart would look like this. Okay, and every candle would give you 4 prices instead of 1. And what 4 prices? So this would give you only 1 price. So this would be here, but we get candle out of it. So on the candle we have 4 prices: opening price, closing price, highest price, and lowest price in that particular time frame. So let's forget about this and focus only on this. This is a daily chart. No, it's not daily chart. This is what happens during one day. You are getting a daily candle. On a daily chart, you would get only this, okay? But on a daily candlestick chart, you get this. You get the first price of the day, last price of the day, highest price of the day, lowest price of the day. Distance between the opening price of the first price and the closing price of the last price is the body. When the body is bullish, so the price rose in that time, the body is usually white or green. When the price went down, the body is bearish, so it's usually black or red. In that particular time frame, the price made local high and the price made local low, which are highlighted by head and tail. Head and tail. All this is a shadow of the candle. This is body, this is head, this is tail, often called wicks. Not John Wick, but about John Wick. Watch John Wick. It's an awesome movie with Keanu Reeves, especially John Wick 2. John Wick 1 is okay, John Wick 3 is okay, but John Wick 2 is absolute legend, amazing film. I think if you like action movies, yes, John Wick 2 is awesome. Especially that Keanu Reeves is a great actor and he prepared well for this role by a lot of training. So these are candles. Also, you can see how I built this candle from this line chart: opening price, closing price, body, highest price, lowest price, tail, head, shadow. All right. Candles can look like this. They don't necessarily need the body, so the opening price and closing price is the same. They can have only body. They can have body and a head. They can have body and a tail. They can have body and both. They can have body and small head but long tail, small body, long shadows, etc. Long wicks. So every combination is possible. And just few of them have actual meaning. So it's not like every candle will give a trading signal. No, most of them are meaningless. But once they happen and they happen on important level, they have meaning and you can trade based on them. This is Marubozu. Marubozu is one candlestick formation which shows you the dominance of one side. In this case, you have bullish Marubozu, which shows you opening price, closing price, and throughout the time, the price rose. Here is bearish Marubozu, opening price, closing price. You can assume that the price was going like this. So absolute dominance of one side. How it looks in practice, here you have a channel up formation, resistance, resistance, support, support, and then support is broken. And to break the support, sellers need a lot of money to break the support, and they eventually manage to do this. But that's an important lesson. Price does not always go like this or like this. Sometimes the price makes a signal, then reverses, and then goes down according to the signal. Don't chicken out in this time. All right. Make sure that your head is in right place, that your thoughts are in right place, because this movement can scare you, right? Right. Because I know that traders very often feel fear when they are trading. Try to avoid it by practicing, 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 learning, learning, learning on the real money. Because on the demo money, you don't care if you will lose 1,000 or 1 million fake dollars, right? On the real money, you start to be emotionally attached even to $50. So make sure you are not. All right? Because once you get attached, you start to get crazy and you start to have stupid ideas. Anyways, this is Marubozu breaking support, which shows you that the price requires a lot of strength and power to break support and reverse the trend. So the other side of the market took control of the market. Here I have Marubozu breaking, also uptrend, but this is Marubozu breaking horizontal support. Okay, some people may say like Marubozu is a candle without tails or head, but if you have like this, does it change anything? No, the principle is important. What is important is that this candle is much bigger than the rest of them. So there was a dramatic shift. It was like this, like this, like this. Boom, dramatic shift in a short way. A lot of money being traded. That's what counts. That's what is important. Also, here I would like to mention one important feature of the price action is that broken resistance. Resistance becomes support and support, which in this case was broken. But keep that in mind, guys. Broken support becomes a resistance and broken resistance becomes a support. That's how it works. Another one, my friends. What is that? That is hammer and shooting star. So this is a hammer. As you can see, it looks like a hammer. This is a shooting star. It looks like a shooting star. Principle between those two is pretty easy. So hammer. The color of the body is not relevant in both cases. What it shows us that the price started here, went down, got rejected, and went up. Yes, exactly. It shows us that the price got rejected. So if it's happening on an important support, it shows us that this support is working. This support was respected. This price of, let's say, 50 was a good price. Traders agree that it's a good price to buy. It shouldn't go below 40 to below 50 to 49. So the price is more probable gonna go up. The same goes with shooting star. So the shooting star shows you that. Let's analyze this one. We went from here, we met a resistance, the price got rejected and went down. So here you can see that the price met a resistance, let's say 100, and traders did not want to pay for this 101. They started to sell to 99, 98, and this is the most probable direction after this kind of a candle. Look at this. This is an upswing. There is a shooting star, but that was beautiful because that's a resistance. Shooting star on a resistance, very strong sell signal. Another shooting star and a drop. Here, drop reversed by hammer and upswing, correction reversed by hammer, upswing stopped by a shooting star and drop. You cannot get any better than this. It is absolutely awesome. Another example, a drop, a hammer, an upswing, a shooting star, reversal. This easy, guys. You don't need to know the GDP of Eurozone or inflation of US or the unemployment rate. No, you just see this and this, you click buy or sell, and you make a decent trade. This is how it looks like, guys. Last formation that I wanted to show is an engulfing. Here is a bearish engulfing, which shows that the price goes up, 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 makes nice bullish candle, and then the second one overlaps the first one entirely. Dark clouds. Actually, there's a formation called the dark cloud cover, but bearish engulfing is more powerful. There is a resistance very often here, and after this the price should reverse, and there is a bullish engulfing, so the price is going down. It's very significant drop, but then reversal because the second candle is positive and overlaps the first one entirely, and after this there should be most probably a further upswing. Let's see in practice if it works like this. So we have an upswing, bearish engulfing. First one didn't work so much, but the second one, yes, and a beautiful reversal. And then the correction, which was also ended by the bearish engulfing and the drop. Here is another example. So you have a drop, you have a hammer, and you have a bullish engulfing. After this, no surprise that the price went higher. You had the first signal of a reversal here, and second one, a confirmation here that this support is super important. This support is crucial. It's a stronghold for buyers, and most probably the price will not break it. All right, guys. I know that it can be complicated at the very beginning. I get this. I had the same. So if you want help, we are here for you. I have a Twitter account, as you can see here, Wisniewski and I advise you to follow my account because I post my trading ideas there. Not recommendations. I do not recommend anything. That's not the trader advice, trading advice. I just share my view on the market. I'm not advising anything. I'm just sharing what I do, what I think about the price. You do with this what you want. You can just learn from it. You can learn because I post my articles, for example, to FX Street, where I explain my transactions. Okay. You can also follow Axiory account. Yes, definitely we can do this. If you have any questions, you didn't manage to come on the webinar. As I said, on the webinar we had a lot of questions, so it was over 1 hour. This recording is 40 minutes, so 20 minutes of questions. If you have any questions, I am more than happy to answer them, or the team is more than happy to answer them if you'll write to support@axiory.com. Any question, if you will have, obviously, I invite you to write to support@axiory.com. In the meantime, read the disclaimer. Again, no investment advices here. This is just a pure education. I am sharing my knowledge with you completely for free. So we are not advising anything. Guys, remember, we are here for you. This is a webinar with Axiory. This is second webinar with Axiory that we did, okay? But it's a start. We will provide you every tool that you need for profitable trading. We are here for you. We just start, but we will cover every aspect of profitable trading in our next webinars. So make sure that you will follow us, that you will open a demo account with us or a real account. You will stay in touch. You will get our promotions. You will get our you will be able to attend in our educational campaigns, which will start shortly. We'll start it with this one. Next one is in November, so very, very soon. Then December, and we will seriously provide top cutting edge, top-notch education done by professional traders who trade on a real market. We will not share pictures from the books. No, we will share the practical knowledge with you. So if you're interested, and I hope you are, I recommend you to join Axiory right now. There is no time to waste on doing something which does not work. Trust professionals. This is my advice to you. Thank you very much for watching this webinar with Axiory. I hope you enjoy this and all the best in the future.